It's 3:47 a.m. in a Singapore trading room. A portfolio manager is staring at four numbers on her Bloomberg terminal, each one representing 25% of her client's wealth. Tonight, that boring allocation is crushing everything else. 26% annualized return. That's what Bank of America is reporting for the 25-25-25-25 portfolio in 2026. The best year since 1933, and almost nobody saw it coming. I'm your host, and today we're examining why the simplest portfolio strategy on Wall Street is outperforming the complex ones, and what that tells us about where markets are really heading. For decades, financial advisors preached the gospel of 60-40. 60% stocks, 40% bonds. It was the bedrock of institutional investing. And then 2022 happened. The 60-40 portfolio lost 16.9% that year, its worst performance since 1937. Stocks fell. Bonds fell with them. The diversification everyone trusted, it vanished when they needed it most. But here's what's strange. While the sophisticated allocations were bleeding, a portfolio strategy your grandfather might have used was quietly doing something remarkable. The 25-25-25-25 portfolio is almost insultingly simple. You split your money into four equal parts: stocks, bonds, commodities, and cash. No optimization. No rebalancing algorithms. Just quarters. Harry Brown popularized a version of this approach in the 1980s. He called it the permanent portfolio, designed not to maximize returns, but to survive anything. Inflation, deflation, growth, recession, all four at once. The logic was elegant. At any given moment, one of these four asset classes would be thriving. Your job wasn't to guess which one, your job was to own all of them. For years, critics dismissed it. Too conservative, they said. You're leaving money on the table. Why hold cash when stocks compound? Why own gold when bonds pay interest? The 60-40 portfolio delivered handsomely for decades. Low inflation, stable growth, and a beautiful negative correlation between stocks and bonds. When one fell, the other rose. It felt like a law of nature. But that correlation isn't a law. WisdomTree research shows the regime that made 60-40 work, low inflation and negative stock-bond correlation, and fundamentally shifted. In 2022, both stocks and bonds fell together for the first time in decades. Investors learned a painful lesson: correlation can turn positive at exactly the wrong moment. The culprit was inflation. When prices surge, central banks raise rates. Rising rates hurt bonds directly. Their prices fall, and they hurt stocks by making future profits worth less today. This is why 2022 was so brutal. The one thing bonds were supposed to do: protect you when stocks fell. They couldn't do when inflation was the problem. The hedging relationship broke. Meanwhile, commodities, the asset class most investors ignored, surged. Oil, natural gas, wheat. They're priced in dollars, so when inflation hits, they tend to rise with it. And gold, the pet rock that pays no dividends, climbed too. According to Fidelity, commodities and gold outperforming stocks is historically a characteristic of bear markets and regime change. Now, 2026 has amplified all of these dynamics. Geopolitical shocks have sent oil prices climbing. Gold has become the hedge investors wished they'd owned. And the simple 25-25-25-25-25-25 portfolio? It's having the run of a lifetime. Bank of America reports the 25-25-25-25-25 portfolio is on track for a 26% annualized return this year. That's not a typo. 26% from the most boring allocation strategy imaginable. That's the best performance since 1933, when the world was climbing out of the Great Depression. History doesn't repeat, but it does seem to rhyme. So what's driving these returns? It's not stocks, they've had a mediocre year. It's the parts of the portfolio that most investors drastically underweight: commodities and gold. Bank of America notes that many investors remain drastically underexposed to commodities despite their strong 2026 performance. They know the returns but haven't acted on them. This is classic investor behavior. We chase what's already worked and avoid what seems risky. Commodities felt risky 5 years ago. Volatile, hard to understand, expensive to hold. So most people avoided them entirely. Here's the thing about diversification, and this is from Metzi's investment research. True diversification means spreading across asset classes, geographies, and economic drivers, not just picking different stocks. When you own only stocks and bonds, you're betting on one economic story, steady growth with contained inflation. That story worked from 1982 to 2020, but we may be in a different story now. SSGA research shows something critical about gold. It hasn't moved in tandem with either stocks or bonds. That's the definition of a true diversifier, an asset that zigs when everything else zags. Think about what happened in 2022. Stocks fell because rising rates hurt valuations. Bonds fell because rising rates hurt prices directly. Gold? It held its ground, not tied to either mechanism. According to Proactive Advisor magazine, gold allocations between 4 and 15% consistently improved risk-adjusted returns across portfolio types over the past decade. Not eliminated risk, improved the return you got for taking it. Now, I want to be careful here. This isn't me telling you gold is the answer. Past performance doesn't guarantee future results, and gold can go through brutal decades of underperformance. It's a tool, not a miracle. What the research suggests is that a small allocation, somewhere in that 4 to 15% range, has historically smoothed the ride. Your portfolio still captures upside from stocks, but the drawdowns hurt less. Some strategists are going further. WisdomTree's analysis suggests a 60-20/20 allocation, 60% equities, 20% fixed income, and 20% real assets including gold. They're treating commodities as a permanent sleeve, not a tactical bet. That's a significant departure from traditional thinking. For decades, the institutional view was that commodities were for speculators. This WisdomTree research argues they deserve a permanent home in portfolios. Here's the honest version, though. Nobody knows if we're in a new regime or just a weird few years. The same analysts who said 60-40 was dead in 2022 watched it recover fully by November 2023 for investors who held through. That recovery is important. The investors who panic sold in October 2022 locked in their losses permanently. The ones who held through? They were whole again within 14 months. Patience paid. So what's the takeaway? I think it's this. The 25-25-25-25 portfolio isn't necessarily the right allocation for everyone, but it's reminding us that diversification means more than owning different stocks. If you're looking at your portfolio today, consider asking, how would I feel if stocks and bonds both fell 15% in the same year? Because it happened in 2022, and it could happen again. You might want to look at your commodity exposure, or lack of it. Many investors have 0% in real assets. Even a small allocation could provide meaningful diversification when you need it most. One approach is to start small. Research suggests that even 5% in commodities or gold can shift your risk profile without dramatically changing your expected returns. It's a hedge, not a bet. For practical implementation, consider looking at broad commodity ETFs that track indices like the Bloomberg Commodity Index. They give you exposure across energy, metals, and agriculture without picking individual sectors. And if commodities feel too volatile, gold ETFs offer exposure to real assets with historically lower volatility than energy or agricultural commodities. Different risk profile, similar diversification benefit. Review your bond allocation too. In an inflationary environment, long-duration bonds may not provide the downside protection you're counting on. Some advisors are shifting toward shorter durations. Here's something that might seem counterintuitive. The cash portion of the 25-25-25-25 portfolio, the part that seems most boring, is actually earning meaningful returns for the first time in 15 years. With money market rates above 5%, that 25% cash allocation is contributing real returns, not just sitting idle. It's working while you wait for opportunities. This is what the portfolio's designers intended. Each quadrant serves a purpose: stocks for growth, bonds for income and deflation protection, commodities for inflation, cash for safety and optionality. When the world shifts, and it always does, you want to own the asset that's responding. The 25-25-25-25 approach guarantees you'll always have something working, even if three quadrants struggle. If you decide to add commodities or gold to your portfolio, consider doing it gradually. One approach is dollar cost averaging into your new allocation over 6 to 12 months rather than making one large purchase. And here's a disciplined move that many investors struggle with. If commodities have surged in your portfolio, that's actually a rebalancing signal. Trim what's outperformed, add to what's lagged. It feels wrong, but it's the process. This is where most people fail. They see an asset class winning and want more of it, not less. But the whole point of diversification is owning things that don't move together and taking profits from winners. If this kind of portfolio construction interests you, hit subscribe. We cover stories like this every week, and if you found this useful, a like really does help more people find us. Let's bring this full circle. The Singapore trader I mentioned at the start, she's probably looking at the same data you're considering now. 4 equal boxes, nothing fancy. And this year, it's beating everything. The 26% annualized return in 2026, Bank of America's headline number, isn't about genius stock picking or perfect market timing. It's about owning asset classes that happen to be ready when the world shifted. That's the lesson. You don't have to predict what's coming. Inflation or deflation, growth or recession, war or peace. You have to be prepared for all of them. The 25-25-25-25 portfolio prepares for all of them. By accepting that prediction is impossible and preparation is everything. Is 2026 a signal that we've entered a new era? Maybe. Or maybe commodities are having their moment before reverting to obscurity. Markets have humbled smarter people than me with their timing. What I know is this: the investors who had commodities and gold when the world got complicated slept better this year. And the ones who didn't are now asking why they didn't. Your portfolio is specific to you, your timeline, your risk tolerance, your goals. Talk to your advisor about what makes sense, but ask them about diversification that goes beyond just stocks and bonds. Because the next time stocks and bonds fall together, and they will, you'll want to own something that doesn't care what they're doing. That's the real lesson of 2026. This content is for educational and informational purposes only and does not constitute financial advice. Always consult with a qualified financial advisor before making investment decisions. Remember, this content is for informational purposes only and is not financial advice.